The silent financial saboteurs. 10 things that no longer offer value. Have you ever stared at your bank balance after a decent paycheck and felt a chill? You earned the money, but your savings account looks tragically underfed. You see colleagues taking exotic vacations and neighbors buying the newest gadgets, all while you wonder if you're the only one who hasn't cracked the code to financial freedom. The truth is, most people aren't inherently better with money. They're simply caught in different, often overlooked, financial traps. We've been operating with a spending playbook that's a decade out of date. Habits that once seemed smart, or at least harmless, have been turned into expensive wealth destroyers by shifting markets, technology, and business models. Here is a breakdown of 10 spending categories that are no longer worth the money, moving from genuine value to outright waste. The dollars you save by avoiding these traps can literally change your financial path. 1. Investing in things you can't explain. This sounds obvious, but the scale of the problem is enormous. The last few years have seen countless people gamble, not invest, serious capital on assets they couldn't define or explain. The trap: chasing hype in volatile markets like meme stocks, unregulated cryptocurrencies, or niche startup platforms. The psychological lure is the fear of missing out, FOMO. The reality: if you cannot articulate the business model, the risk profile, or the exit strategy in simple terms, you are not an investor, you are a speculator. A single, ill-informed gamble can erase years of dedicated savings. The fix: knowledge is your ultimate protection. Before you commit $1, commit an hour to research. Only invest in companies or assets whose underlying value you truly understand. Paying for, set it and forget it, car insurance. Car insurance is a mandatory expense, but for millions, it's a massive and unnecessary annual overpayment due to pure inertia. The trap: insurance companies rely on your laziness. They count on customers automatically renewing policies, allowing them to quietly increase premiums year after year. The reality: rates change constantly based on market competition, your driving history, and even your credit score. Many people overpay by hundreds or even thousands of dollars simply because they haven't shopped around in years. The fix: dedicate 30 minutes a year to comparing quotes online. The potential savings, which compound year after year if invested, make this one of the highest paid tasks you can perform. 3. Most short-term rental bookings, e.g., Airbnb. The original appeal of getting a unique, cheaper alternative to a hotel has been eroded by a complex structure of hidden costs. The trap: seeing a low advertised nightly rate that doesn't reflect the final price. The reality: the true cost is bloated by mandatory cleaning fees, service charges, and sometimes local taxes that often make the final price higher than a comparable hotel. Moreover, you are often expected to perform housekeeping duties, stripping beds, taking out trash, while paying a premium for cleaning. Hotels offer transparent pricing, daily service, and better cancellation policies. The fix: before booking, check the all-in price after fees against a hotel of similar standing. In many cases, the hotel is now the superior and cheaper option. Extended warranties and service plans. These checkout counter add-ons are marketed as peace of mind, but are little more than high-margin profit centers for retailers. The trap: fear of a large repair cost motivates you to spend a smaller, seemingly trivial amount for protection. The reality: extended warranties are loaded with so many exclusions, wear and tear, water damage, improper use, and only kick in after the original manufacturer's warranty expires, making them largely worthless. The cost of the warranty itself often represents 15 to 25% of the item's price, and the funds used to pay for them have a much higher opportunity cost, i.e., they could be invested. The fix: decline them. Self-insure instead by putting that $50 to $100 into a dedicated emergency fund. That fund protects you from all unexpected expenses, not just one specific product defect. 5. Bulk buying food that spoils. Buying in large quantities should save you money per unit, but this strategy often fails spectacularly with fresh, perishable goods. The trap: the psychological relief of seeing a lower price per pound convinces you you're saving money. The reality: the average household wastes around 20% of the food they buy. Bulk buying fresh produce, like a giant container of strawberries or a massive bag of salad, simply amplifies that waste. You may save $1 on the per pound price, but you lose $10 when half of it goes bad before you can eat it. The fix: only buy in bulk for non-perishable items, toiletries, canned goods, frozen staples, or items with a very long shelf life. 4. Fresh food. Buy only what you know you will consume within a few days. Sale items you don't actually need. Retail psychology is designed to make you equate saving money with spending money. The clearance rack is a financial black hole for common sense. The trap, the percentage discount, 50% OFF, creates an artificial sense of urgency and scarcity, overriding rational thought. The reality, you are not saving money when you buy a $35 item you never wanted. You are spending $35. These items, the clothes with tags still on, the unused gadgets, clutter your home and drain funds that could have paid down debt or been invested. The fix, adopt a simple rule. Never buy something just because it's on sale. Only purchase an item if you needed, wanted, and would have bought it at full price. Obligatory, unnecessary gifts. The holiday and birthday gift exchange economy has become a massive, zero-sum financial trade that enriches retailers and clutters homes. The trap, feeling socially obligated to spend money on people who neither need nor truly want the item you buy for them. The reality, in many circles, co-workers, extended friends, the giving becomes a financial merry-go-round. You spend $50 on them, they spend $50 on you, and you both end up with unwanted clutter. Love and friendship are not measured in retail receipts. The fix, initiate an honest conversation about simplifying. Propose a secret Santa exchange, an experience-only gift policy, or a mutual agreement to stop exchanging gifts among adults. Paying for degrees that don't pay you back. The higher education system has convinced generations that any degree is a guaranteed path to prosperity, regardless of the cost or the market value of the major. The trap, borrowing a 5- or 6-figure sum to obtain a degree in a field with limited job prospects or a low average starting salary. The reality, an investment is supposed to generate a return. If the debt payments from your education choke your income for the first 15 years of your career, preventing you from saving for a home or retirement, it was not an investment, it was a financially catastrophic mistake. The fix, be ruthlessly strategic. Prioritize community college, in-state tuition, scholarships, and fields of study with a demonstrable job market and favorable financial return on investment. Small, unconscious daily spending, the latte factor. These are the tiny, convenience-based purchases that feel insignificant on their own but become shockingly large financial drains over time. The trap, the $6 morning coffee, the $12 takeout lunch, the impulsive energy drink. Each transaction is minor and forgotten within an hour. The reality, a $10 daily habit costs you $3,650 annually. If you have 2 or 3 such habits, you are easily wasting thousands of dollars that could be building your emergency fund or going into an investment account where it would compound into significant wealth over decades. The fix, track your spending for 1 week and identify your top 2 convenience drains. Replace them with a cheaper, prepared alternative, e.g., making coffee at home. Overpaying for housing. This is the single biggest expense that derails more financial goals than any other, whether you are renting or buying. The trap, buying or renting the absolute maximum you can afford, often pushed by social pressure or lifestyle creep. The reality, when housing consumes 40 to 60% of your income, you are effectively house poor. You become a slave to your monthly payment, with no financial flexibility for saving, investing, starting a business, or handling an emergency. The fix, practice house hacking, or simply choose a house or apartment that is below your maximum affordability. The money freed up from a lower housing payment is the most powerful tool you have for building true long-term wealth. Airbnb. The platform started as a way to find affordable, unique accommodations that were often cheaper and more interesting than hotels. That value proposition has been completely destroyed by fees, inflated pricing, and policies that favor hosts over guests. Here's how the numbers actually work out now. You see a listing for what looks like a reasonable nightly rate, let's say $150. Then you get to check out and discover there's a cleaning fee of $75, a service fee of $30, and various other charges that weren't immediately obvious. Your $150 room just became $255, and that's before taxes. Compare that to a hotel room at $200 per night with no hidden fees, daily housekeeping, a front desk for problems, loyalty points, and the ability to cancel without losing money if your plans change. The Airbnb isn't just more expensive, it's less convenient and more risky. For frequent travelers, this adds up to hundreds of wasted dollars per trip. People who travel for work or take multiple vacations per year are literally throwing away thousands annually by choosing Airbnbs over hotels based on advertised rates that aren't real. The platform has essentially become a way for property owners to run unlicensed hotels while charging premium prices and providing substandard service. The cleaning fees alone are often ridiculous. Like you're paying $75 for cleaning, but you're also required to do dishes, take out trash, and strip beds before you leave. So, you're paying premium prices for the privilege of doing housekeeping work. Hotels provide daily cleaning as part of the standard service. Yet, somehow, we've been convinced that doing the work ourselves while paying more money is a good deal. The psychology behind extended warranties is fascinating and depressing at the same time. You're standing at the checkout counter about to buy a $500 appliance, and suddenly the salesperson becomes your best friend. They're deeply concerned about your future happiness and want to protect you from the devastating financial blow of potential repairs. For just $99, you can have peace of mind. What they don't mention is that extended warranties are pure profit centers with rejection rates that would make a dating app jealous. Here's the math that retailers don't want you to see. Extended warranties typically cost between 15 and 25% of the item's price, but the actual claims rate is usually under 15%. That means for every $100 consumers spend on extended warranties, only about $12 goes toward actual repairs. The rest is profit for the retailer and the warranty company. But wait, it gets worse. Y'all, most extended warranties don't even kick in until after the manufacturer's warranty expires. And they're loaded with exclusions that make them almost worthless when you actually need them. Water damage isn't covered. Normal wear and tear isn't covered. If you move the appliance, that might void the warranty. If you didn't register it within 30 days using a process that requires 3 forms of identification and a blood sample, it's void. The real kicker is that most people never even try to use their extended warranties when something breaks. They either forget they have them, can't find the paperwork, or discover that the repair process is so complicated and time-consuming that it's easier to just buy a replacement. Meanwhile, that $99 you spent on warranty protection could have been invested and earning returns for years. If you're buying extended warranties on multiple items per year, you're easily wasting $500 to $1,000 annually on protection you'll probably never use and probably wouldn't work if you tried. That money could fund an emergency fund that actually protects you from unexpected expenses, rather than funding an insurance policy that exists mainly to generate profits for retailers. Let's move on to something that sounds incredibly smart and responsible, but often turns into an expensive lesson in food waste. Buying food in bulk when half of it ends up spoiling. The wholesale club membership seemed like such a good idea. You're going to save money by buying larger quantities at lower per unit prices. You're being a savvy consumer, thinking ahead, planning for the future. Then reality hits and your refrigerator becomes a science experiment. The average American household throws away about 20% of the food they buy. 20%. That's like taking every fifth grocery dollar and setting it on fire. For a family spending $400 monthly on groceries, that's $80 worth of food going straight into the garbage. Over a year, that's nearly $1,000 of waste, and that's just average. Some families waste significantly more. Bulk buying amplifies this problem exponentially. You buy the giant container of strawberries because the per-pound price is better, but strawberries last about 15 minutes before they start looking like a biology project. You stock up on fresh vegetables with the best intentions. But life gets busy. You order takeout a few times, and suddenly you're composting $50 worth of produce. The psychology is predictable. When you buy large quantities, you feel less guilty about waste because each individual item seems cheap. Throwing away one apple from a 3-pound bag doesn't feel as bad as throwing away a single apple that costs $2. But the math doesn't care about your feelings. Wasted food is wasted money regardless of how you rationalize it. Even worse, bulk buying often leads to overconsumption of the things that don't spoil, like processed snacks and frozen foods. You buy the economy-size bag of chips because it's a better value, then eat twice as much as you normally would because it's there. You're saving money per unit while spending more money overall and potentially compromising your health in the process. The solution isn't to never buy in bulk, but to be brutally honest about your actual consumption patterns. If you're consistently throwing away fresh food, You're not saving money by buying larger quantities. You're just wasting money in bigger increments, while convincing yourself you're being financially responsible. Here's something that gets almost everyone because the marketing psychology is so powerful. Buying sale items you don't actually need. The clearance rack is like a black hole for common sense and disposable income. You see something marked down 50%, and suddenly your brain starts doing mental gymnastics to justify why you absolutely need this thing you'd never heard of 5 minutes ago. Retail psychology has turned saving money into spending money. And most people don't even realize it's happening. You walk into a store looking for one specific item, but there's a sale on something completely different. The original price was $70, but today only it's $35. You're saving $35, except you're not saving $35. You're spending $35 on something you didn't want or need until a price tag told you it was a bargain. The average person spends hundreds of dollars per year on sale items they never use. Clothes that hang in closets with tags still attached. Kitchen gadgets that take up drawer space but never see actual food. Books that sound interesting at clearance prices but never get opened. Electronics that seem like good deals until you realize you already have something that does the same job. Here's what makes this particularly insidious. Every time you buy something on sale that you don't use, you're not just wasting the money you spent, you're also giving up the opportunity to invest that money or spend it on something you actually value. That $35 clearance purchase could have been $35 toward paying off debt, building an emergency fund, or investing for retirement. The clearance mindset creates a scarcity mentality that overrides rational decision-making. You feel pressure to buy now because the sale won't last forever. Even though similar sales happen constantly, retailers rotate their clearance inventory specifically to create this sense of urgency and scarcity. There will always be another sale, another clearance event, another limited time offer. The solution is simple, but requires discipline. Hey, never buy something just because it's on sale. Buy things because you need them, want them, and would purchase them at full price. If the only reason you're considering a purchase is the discount, walk away. Your bank account will thank you, and your living space won't be cluttered with regrettable bargains. Now, let's talk about something that hits people right in the emotions in the wallet simultaneously. Unnecessary holiday and birthday gifts. The average adult spends between $500 and $1,000 annually on gifts for people who probably don't need or particularly want what they're receiving. We've created this elaborate system of obligatory gift exchange that enriches retailers while stressing out consumers and cluttering up everyone's homes with stuff they don't use. Think about the last 10 gifts you received that weren't from immediate family members. How many of those items do you still use regularly? How many brought genuine value to your life? How many are sitting in a closet, drawer, or garage serving no purpose other than generating guilt when you consider throwing them away? Like, the gift-giving industrial complex has convinced us that love and friendship are measured in dollars spent at retail establishments. Here's what's really happening. You spend $50 on a gift for your coworker's birthday party. They spend $50 on something for you when your birthday comes around. You both end up with items you don't particularly want, paid for with money you both could have used for something meaningful. It's like a complicated money laundering scheme where everyone loses except the retailers. The worst part is that gift-giving has become this weird financial hostage situation where nobody wants to be the first person to suggest maybe we should all stop buying each other stuff we don't need. Meanwhile, everyone is secretly hoping someone else will suggest it first. It's like a Mexican standoff. But instead of guns, everyone's holding credit cards they can't afford to use. The solution isn't to become a holiday Grinch or skip every birthday party. It's to have honest conversations about simplifying gift exchanges or focusing on experiences rather than objects. Some families have started doing Secret Santa instead of buying gifts for everyone. Others have agreed to skip gift exchanges entirely for adults. A few progressive groups have instituted spending limits or agreed to only give homemade gifts. The point is to stop letting retail calendars dictate your spending habits. Let's shift gears to something that's destroying entire generations financially. Paying for degrees you don't use. The higher education industrial complex has convinced millions of people that any degree is better than no degree regardless of the financial mathematics. Meanwhile, graduates are walking across stages with pieces of paper that cost more than luxury cars and qualify them for jobs that pay less than skilled trades. Here's the brutal reality check. If you borrowed $40,000 to get a degree in a field where the average starting salary is $35,000, you didn't get an education. You got scammed. The debt payments on that education loan will follow you for decades, preventing you from buying a home, starting businesses, or building wealth during your prime earning years. The psychology is understandable. Society has spent decades telling young people that college is the only path to middle-class prosperity. Parents want their children to have opportunities they didn't have. Students believe they're investing in their future earning potential. But when the math doesn't work, good intentions become financial disasters. The irony of student loans is particularly cruel. You're told education is an investment in yourself, but investments are supposed to generate returns. If your education generates negative returns for the first 15 years of your career, that's not an investment. That's an expensive mistake with a graduation ceremony. This doesn't mean education is worthless. It means being strategic about what you study and how much you're willing to pay for it. Community college transfers, in-state tuition, scholarships, and choosing fields with actual job prospects can make education a genuine investment rather than a financial death sentence. But borrowing 6 figures to study something with limited earning potential is like buying a Ferrari to deliver pizzas. Moving on to something that seems insignificant but adds up to shocking amounts over time. Small daily spending habits that provide zero lasting value. That $6 coffee every morning. The $12 lunch you grab because you didn't meal prep. The random snacks, energy drinks, and convenience store purchases that happen without conscious thought. Here's where the math gets depressing. A $10 daily habit cost you $3,650 annually. Most people have multiple $10 habits. The morning coffee run, the afternoon snack attack, the evening convenience store stop for whatever caught their eye. We're talking about enough money to fund a vacation, make significant debt payments, or build substantial emergency savings. But it's not just about the immediate cost. It's about the opportunity cost of that money. $10 invested daily at reasonable returns becomes enormous wealth over decades. Instead, it's buying temporary satisfaction that's forgotten within hours. You're trading long-term financial security for short-term convenience and momentary pleasure. The psychological trap is that each individual purchase feels insignificant. $6 for coffee doesn't seem like a big deal when you're earning decent money, but $6 multiplied by working days multiplied by years becomes a substantial sum that could have changed your financial trajectory if deployed differently. Finally, let's talk about the big one, the expense that kills more dreams than any other. Overpaying for housing. It's like whether you're renting or buying, housing is typically the largest expense in most people's budgets. And because it's so large, even small mistakes in this category have massive financial consequences. The traditional advice is that housing should cost no more than 30% of your gross income. But in many markets, people are spending 40, 50, even 60% of their income on housing costs. This leaves virtually nothing for saving, investing, or building wealth. You become a slave to your mortgage or rent payment, working primarily to keep a roof over your head. Here's what happens when you overpay for housing. Every other financial goal becomes secondary. You can't build an emergency fund because all your money goes to housing costs. You can't invest for retirement because you're house poor. You can't take career risks or start a business because you need every paycheck to cover your oversized housing payment. You become trapped in a golden cage of your own making. The solution requires uncomfortable honesty about your actual needs versus your wants. Do you need the prestigious neighborhood or do you want it? Do you need the extra bedroom that will sit empty most of the time, or would a smaller space allow you to build wealth? Do you need to buy right now, or could you rent affordably while saving for a larger down payment? Housing decisions made in your 20s and 30s determine your financial flexibility for decades. Choose wisely because this single category can make the difference between building wealth and staying broke despite earning good money. There you have it. It's those 10 things that are no longer worth buying, representing thousands of dollars in potential savings annually for most people. The beautiful thing about avoiding these financial traps is that the money doesn't just disappear. It can be redirected toward things that actually build wealth and improve your life. Stop funding these industries built on your financial ignorance and start building the life you actually want instead.